So much, Rolly, and everyone else at Trading Pub for having us. I was listening in quite keenly to everything Larry was saying. It's always a pleasure to be presenting alongside such great traders. This is actually only the second time I've presented this particular topic, so I'm really excited to actually have the opportunity to share this with you. It's going to be focused today on looking at the DNA, essentially, of what moves in equities, and not just equities, but forex, futures, stocks. Basically, looking at what makes up technical analysis to move all these underlying instruments. Because whether you're going to trade futures, options, stocks, obviously where the money's made is by being able to predict where the instrument's going to go, or in some cases where it's not going to go. So I'll be taking you through this today. Of course, the standard disclaimer on the screen. We will be talking about some live stocks at the end, and I'm happy to take questions on any kind of stocks that you're currently looking at. So obviously it's not a recommendation to buy or sell, but for educational purposes only. But this is basically the agenda that I'm going to take you through. What we're looking at when we go into learning to trade anything, I think that a lot of traders I've met over the years will sit in front of me. For example, I met with a gentleman recently who's 10 years trading, and he sat across my desk, and I said, well, what's this pattern? And he said, well, that's bullish. And I said, okay, great. What about this pattern? He said, well, that's bearish. I said, yes, correct. What about this pattern? But then I asked him why. I said, why is a rising wedge bearish? And he couldn't tell me, because he'd learned all the whiz-bang terms, and he'd learned how to, knew what he was looking at by theoretically, but he had never learned what actually made it bearish or bullish and what was going on behind the scenes. So the focus today, as I do with all our classes, is to try and give you an understanding top-down of what the and then how we develop fairly advanced techniques of trading it by understanding that DNA. So we'll talk about reverse engineering the smart money. We'll talk about developing a process-driven way of predicting market direction. And then I'm going to share with you a checklist that basically allows you to follow the same process every day to create that consistency, and then how we take that and develop it into an idea of scans. So it's essentially a very kind of top-down, right down to the details, and then we'll be looking at the live Q&A and the summary of all the trades we've been picking since June and how those have gone. So to start out with, just on a very high level, I always like to just get a gauge of what type of group we have. I know it often varies quite dramatically from day traders all the way down to long-term investors. So if you feel like sharing, what type of trading you are concentrating on, it'll help me focus on some of the types of opportunities we look at through some of the live examples today. But obviously we do have all types of trading, and the strategies I'm going to be talking to you about today do apply to all three, because we're talking about how money moves through technicals, and that's on all time frames. The other question I always ask is, it's the same 6 cliche images you see in any financial opportunity, so I apologize for that, but this is an important question to ask when we're approaching the market from a top-down standpoint, is what do we actually want out of trading? I see, because a lot of people I've talked to, don't match up what they're doing with what they want. So they're looking for more time, or they're looking to travel, and then they end up sitting in front of the screen for 8 hours a day, or they retire from their job and because they want to enjoy life, and end up frustrated because they spend 6 hours scanning for stocks. So you've really got to make sure that your strategy complements your objective as well. And then the final question, which is getting a bit more into the focus of tonight, is then how do you make your decisions? So in today's, if you look at how the market made its decisions 20 years ago, it was fundamentals. It was the news. It was ideas from friends. It was brokers, maybe things you're familiar with. This is a picture of Vancouver, where we are. It's actually our office right there. But that was how the market made their decisions. It was based on news that we got on a day-to-day basis, maybe a radio show we used to listen to each morning, a newspaper at the door. So fundamentals was how the market operated. This has obviously changed a lot. So thinking about how you get your ideas is also where it all starts. But what I want to do tonight is talk about, regardless of how you get your ideas and how you start the process, what we really need to do is we need to have a way of funneling that into a process-driven, quantifiable methodology. Because without that process-driven way, that kind of more scientific process, we're going to be left with inconsistency. We're going to be left with, emotional decision making. We're going to easily get, locked into trading ideas because we become attached to them. All these kinds of issues where we just take essentially unnecessary risk. And emotional decision making, which isn't based on strict rules, is why people lose money. Logically speaking, if you just gave a darts to a monkey and just threw him at the dartboard to pick stocks, you've got a 50-50 chance of making money, right? The stock can go up or down. So if you've got a 50-50 chance of being right with no real strategy, why do 95% of people lose? Well, the thing is that there is something that everyone shares in common, which is emotions. And the emotional decision making is common with a lot of new and even intermediate traders. And the market knows that. And what the market makers in the stock market's really good at is knowing how most people trade. And by knowing that, they can do the opposite and take the money from the pockets of people who don't know what they're doing. So we'll talk a bit more about that when we get into some of these technicals. But it is tough. There's a lot of noise out there. There's a lot of things to distract you. And the first step we need to do is start taking that noise away and start defining things on more of a, again, process basis. You'll hear me say that a lot tonight. So let's start out with the real easy stuff. What types of markets do we have? What is the stock market? Well, we've got up, we've got down, we've got sideways. And there's three directions that we can actually make money from. Unfortunately, most people only make money in the upward markets. So if you think of it that way from a business standpoint, they're missing out on 67% of the opportunity. So they're only making money a third of the time if you're making money only in the up market. If you're a bit more advanced, hopefully you're shorting stocks. And so then you're taking advantage of the other directional trend. But of course, there's also sideways markets as well, and maybe this is the least common of directions that people take advantage of. Of course, credit spreads, like Larry was saying, calendar spreads are ways to do that. And you can make money from all three. So if we're in the business of trading, why would we shut ourselves off? So now we've talked about the directions of the market. The next thing that we then want to define is something a little less spoken about, and that is the types of market cycles we can have. So I find that even in intermediate traders, this is not often something that's really taught often, because there's three types of market cycles we want to understand. We've got oscillation, consolidation, and momentum. And when we look at a stock or an index, the first thing we need to determine is what personality or cycle is it in. I've chosen an example here of where we can actually see all three on Chipotle Mexican Grill. So you can see here Chipotle, basically, through March through May, is in an oscillating pattern. It's going back and forth between basically fixed limits, fixed permutations. And so the most important thing when we're looking at an oscillating stock is absolutely not the moving averages. We don't actually care at all about the moving averages. We want to know where the limits of where it's able to oscillate back and forth are. So we've got the top line, the midline, and the bottom line. And by knowing that, that tells us where the trades are. The personality then shifts. You can see it breaks the channel. That's our first warning that that the system is changing because it's broken. And then it shifts. And here we now go into consolidation, which is a type of oscillation, but it's basically much more directionless. And it bounces back and forth. And then right around May 22nd, which is when the entire market actually went into momentum mode, this is when the static lines don't matter anymore. We're not looking at oscillating indicators. Now we go into momentum mode, and this is where the moving average is now the system of support. And so the strategies we use, the indicators we use are all dramatically different if we're looking for highly probable trades, whether it's on options, futures, or stocks. So this comes back to then, again, the question of what is your strategy for each of these markets? If we're in an oscillation market, what are you looking for? Momentum, what are you looking for? And it's important to get this down, right? We should know what we're looking for. A poker player knows what the best hand is, and he knows what he's waiting for. A stock trader should know what hand, so to speak, he or she is looking for. So what is the perfect chart? If you were to sit down and draw that, what would the candles be doing? What would the volume be doing? What pattern would it be? Would it be a double top? Would it be a head and shoulders? Would it be a diamond bottom? What is the strategy or pattern that you find is ideal? And then once we know exactly what the chart is that we're looking for, what would the conditions be? So what P to E ratio? What sector? What indicators would you be using to confirm that trade? And what would you be looking for from them? And essentially, we should be able to then have a shopping list of exactly what we want. Because this is your money. This is your retirement. This is your income, maybe. And any other thing financial, we usually have this shopping list. We don't go out looking for a four-seater car with a roof rack for the skis and come back with a motorcycle. Normally we have a shopping list. So let's try and do that with our stocks. Without that, it's almost impossible to be consistent. And as they say, if you don't know where you're going, any road will take you there. So let's start drilling down further. Let's ask the most basic question. Who controls the market? Because ultimately, what I think about a company doesn't matter. I might be right. It might be the best thing since sliced bread. It might be the next Apple. But you know what? If the market doesn't agree with me, it doesn't matter. So what we need to know is, how do we know what the market's thinking? Who controls the market? And very basically, volume. Volume controls the market because volume dictates price. So who dictates volume? We probably all know the answer to that. It's the smart money. So the next question, of course, drilling down, how does smart money work? Well, 70 to 80% of the trades, this was estimated about 3 years ago, so it may even be much higher now, but they estimate a very high proportion of the volume in the market comes from these computer-driven decisions. So how do these computers make decisions? Through strict rules. There's patterns that they follow, and these patterns have rules. The best example I can think of that would be football season's just started. So I remember when I watched my first football game, and as Rolly was saying, I am a Australian born over here in North America now, but basically when I watched my first football game, I remember thinking it was chaos. The ball, the whistle goes, players running all over the map in different directions, hitting each other, balls flying. I thought, this is chaos. How could anyone understand this game? But the more and more I watched it, the more it made sense, and I related it to the stock market. And I thought, well, in stock markets, it's very similar. Basically, what you've got is you've got a playbook, a series of patterns that a stock can move in. And to the common eye, it looks chaotic because it's constantly changing patterns, so it doesn't look to have order. But if you start looking at these patterns on a consistent basis, it's the same thing again and again and again and again. And so the benefit of actually focusing in on understanding the high-frequency trading is that, it is powerful, and it can move markets like it did in 2010, massive directions very, very, very quickly. And it doesn't matter what people do when the frequency trading models kick in. So when you've got that kind of power, the beauty is that it's reverse engineerable, because it is just doing the same thing again and again. And if a football team threw a Hail Mary 6 times in a row, you'd be able to pretty well defend against that the next time it happened. So the idea of looking at the high-frequency trading and smart money is that is the most important thing to me. It's not the fundamentals. It's tracking what the smart money is doing or has done, because they've already looked at all that stuff. So tracking their decision-making becomes very interesting. Now, so drilling down further, the first step to developing a strategy out of this then is to define how smart money works. Smart money works with hard and fast decisions, so or using rules. So the first kind of statement we want to make before we go into strategy is that a stock will not, well, a stock, an index, whatever, a stock will not change direction unless it hits one of the following things. So it has to hit a horizontal level, a diagonal or trend line level, or a moving average. And depending if it's an oscillating or a momentum stock, will depend on which of these three are most important. So what that allows us to do by taking that in as a truth, it means that when we look at a chart, we have to explain why a stock changes direction. So we can look, when we look at any stock, we have to explain why it's changed direction. And and once we've drawn that on, once we've explained it, you can, and you've put on the lines, support, resistance, or whatever the moving average is, what you should then be able to do is take away the stock, and depending on what the shape is that you're left with, that's going to tell you the pattern and the tradable zones. So if after you've taken the stock off, you're left with a shape like that, it's an ascending triangle. But that's our job. We have to explain how the stock moves. And the reason why is because algorithms don't see the stock. What they see is what's left when you take the stock off. They see levels. Again, whether it's horizontal, diagonal, or moving averages, they are programmed to buy when levels are hit, not when they get up in the morning or whatever the case might be. As a question, can Bollinger Bands cause it to change direction? Absolutely. We'll be talking about that soon. So looking at levels is much more important. Flash crash of May 2010, for example, the level that it bounced off wasn't just an apparition. It wasn't some random price. It was the same level that it had recovered from after a very nasty down tip in January. So this magic floor is where it then rallied off once more, straight up into the same resistance level that it broke from. So if you think about how valuable knowing where these levels are would be, it's very valuable. So the trick is finding the strong levels. So because there's obviously lots of different levels on price, and we don't want to trade them all. What we want to do is we want to focus on where the high probability levels lie. So if we're dealing with an oscillating stock, so something that goes back and forth between fixed points, then what we're going to be dealing with is we're going to be looking for several types of aspects to the trade. So firstly, when we're dealing with oscillation and we're finding the key levels, a couple of things we want to understand is that oscillating stocks bounce between fixed limits. Therefore, the moving average is useless. The moving average, like your 9 or 20 day, is basically just going to run through the middle of a stock. Because if it goes from 9 to 11, 9 to 11, well, the average is 10. And if you keep buying and selling when it crosses that average, you're going to lose your money. So in an oscillating stock, we forget the moving averages, we look at the limits. So yes, as the question from John, Bollinger Bands can be useful, but be aware that when a stock breaks outside the Bollinger Band, what that means is that it's gone into an area, or it's broken an area that it spends about 95% of its time inside. And that can mean that it's going to reverse, but what it also means is that it's had an extreme move. So that could also mean because something incredibly good is going on and it's going to go up another 30%. So what you need to know when you see stocks break outside their Bollingers is if it's accompanied by momentum or weakening momentum, and that will tell you which direction to go. But without getting too off track, this is why we are looking at these types of static levels. So let's go to a hypothetical chart. When we're looking for strong levels, there's a few things that we want to look for. Essentially, when a stock drops to support, if the high-frequency trading or the smart money steps in there, which is what we're trying to find. We're trying to find an area where the smart money buys so we can find another opportunity to buy again. So the first thing we're looking for is we're looking for the way that the stock bounces. Okay, because if the smart money is in control, if they're the buying behind the stock, they're coming in with such impressive power that it should go straight up. You know, just like the flash crash. Straight down, straight up. That's what we're looking for in the chart. We want to see an aggressive reaction to the price. That's the first thing we want, is a powerful bounce and a fast bounce. The next thing we want to look for when we're assessing the chart is we want to look for how far it went. Because if we have a really powerful move, we want to see that it actually went up a fair distance. So if it hit support and only went up a couple percent and then sat there for a few days and then went up another couple percent, not interested, not for an oscillating trade. Okay, so we want to see a powerful drop and reaction, and we also want to see a substantial move from that reaction. And finally, we want to look at how many times the zone has been tested before. So just a quick question to the audience. When you're looking at support and resistance, do you generally look for more or less bounces if you're going to have confidence in that support zone? Do you look for more or less times that it's tested that before? Okay, so I see a few people saying more. It's always different, and there's no wrong answer. Okay, so I would argue when you're dealing with an oscillating trade, you actually want less. And the reason being is it comes back to why 95% of traders often lose money, is that we think about things logically. We think, well, if something's bounced off $10, you know, 5-6 times, then surely that must mean that that's a stronger level. So, hey, the next time it hits $10, that seems like a sure thing. Yeah, just like if you were watching a horse and it won 5 out of its last 5 races. We say, well, hey, we got confidence in this thing winning again. But that's the logical response. And what the stock market knows about this then is that there's going to be, when everyone figures out that $10 is the next guaranteed thing, the next time it hits 10 and people start buying, that's when the smart money sells because they've got buyers. In fact, not only will they sell, but they'll probably short and take the thing down, stopping everybody out and reinforcing that downward pressure. So yes, as Theo says, the more times a level is tested, the greater the likelihood it will break. And you go and have a look at any kind of stock pattern, you'll see that that rule of 3 is very important. So more than 3 times, and I don't even look at that level anymore as a support. Okay, so the hypothetical question here now to put this to the test is, if this was a chart you were looking at, the common thing that people do when they look at a chart is they say, what should I do now? Right? Maybe because they only trade that stock, because they like Apple. So they force themselves to only trade Apple. So a lot of the time people are constantly looking at a chart saying, what should I do now? What I would argue is you replace that thought process with, do you even want to do anything? So not what should you do now, but where would you even be interested in trading the stock? And I would argue that in a given chart, in a given year, there's maybe only 5 or 10% of the time that it's even worth considering a trade. And to that, there's probably only about 5% of stocks, 5 to 10% of stocks that are set up that way. So you know, the idea is to figure out what you're looking for, like I said earlier. So playing only the perfect hands. So in this situation, if you were given this chart and you say, well, where would I even be interested in trading this? Going long at the bottom, going long at the second arrow, so A, B, going short at C, or going short at D, which do you think would be the highest probability trade that we should wait for? So if you're thinking A, that would be the one I would pick. It's the strongest move, 1, 2, 3 levels. It's also fresh, only been hit once, whereas the others are either not as strong or have been tested too many times. So basically, when you're looking at oscillation, you have this checklist. You're looking for correlating trades with the market and sectors, but then for the oscillation mode, you're looking for high probability zones as defined by previous strong levels, fresh levels, and powerful levels. So strong levels, fresh levels, and powerful levels. So here's an example. AARON's. AAN, great example of oscillating trades. Trades 30 million bucks a day. So it's not a penny stock or anything like that. But on 30 million bucks a day, you've got to have a pretty good power to move. And you can see here, this 2450 zone touches on it straight up to 2850. So what we're now doing is we're waiting for the next opportunity to play that again. And it comes around about 6-7 months later. And it actually gaps down from 28, opens at 2450, and again, just like the flash crash, the lights go from red to green, and massive amounts of buying automatically happens. And if you had a buy limit down at 2460 or something, you would be too. You'd be in, and you'd be taking profit on the way up, somewhere around probably 2650. So a nice easy 10%. What you might notice is we've got another level just like that happened here at 2650 up to 32. So this allows us now to locate the high probability, high profitability trade the next time it comes down. And there we rally to 29. So up that roughly 10%. We then come down and hit it a third time. And where do we go? We're straight up to 32 and straight back down again. This is high frequency trading. This is how you can take advantage of it. It's not that difficult if we're patient and we wait for the trade to come to us. And this is then, now we've identified it as this type of a trade. Now we can look at the signs of overbought and oversold. Now we can look for what volume is doing. Now we can go into indicators such as the Bollinger Bands and look at elements that will enhance the probability of the trade. Okay, so let's switch gears now. Let's talk about the other side of the market, because the other side is momentum. And momentum is a completely different animal. If we're dealing with a momentum trade, we don't want to be looking for a stock for example, outside the Bollinger as a shorting opportunity, because the stock being outside of the Bollinger, if it's coming with strong momentum, means it's probably going to continue in that direction, and that's why it was outside the Bollinger, because it has so much power that it's making big moves. So understanding the difference is critical between shorting a stock when we should be going long on a breakout. So momentum is where we now look at moving averages. It's where we don't buy the bottom. We're not buying as close to support as possible using the horizontals. We're actually waiting for it to start moving in a direction before we buy it. Whereas oscillation, we want to buy it as low as possible. We're going to be also using different indicators. So for oscillating trades, oscillating indicators. For momentum, we're going to be looking at things like rate of change, MACDs. We're going to be looking at ease of movement. We're going to be looking at basically money flow, things that show us if that momentum is there. So as we talked about at the beginning, this is just an example I pulled up from, it's actually one of our recent stock picks from our executive summaries that the videos that we email out. And you can see this is a perfect example of a momentum trade. It's a fallen angel is what we call it. This thing traded all the way up to, I think, $14. It's had a really tough time. Broke its resistance here. You can see following under the moving averages the whole time. Up, hits the trend line, and there you go, and curls up. And that was where we picked, I think it was around $2.60 up to $3.33. And it did that, accomplished that in 3 days. But that's a great example of momentum, completely different to the personality of the stock we looked at before. Now, that's big stocks are like this too. That's a small stock, but I mean, Chipotle is another example. You look at the way that it just climbs its moving average, not looking at trend lines, looking at that momentum. Okay, so then the final thing that we then want to look at is we want to look at the smart money. So when we talk about technical indicators and all the stuff that we do in charting, what are we ultimately trying to figure out? We're ultimately trying to figure out where's the stock going, so we can trade options on it, so we can buy the stock maybe, whatever the case might be. But no matter what type of strategy you're doing, where you're going to make the most amount of money is being really good at figuring out where the stock will be and when, if you're trading options. So all these indicators are doing is they're analyzing three things: time, volume, and price. There's nothing else to analyze in technical indicators. So what we want to do is start to think about not what we're looking for from the technical indicator, but actually what's going on in the DNA of the stock. So when you think of an uptrend, what is the technical definition of an uptrend? It's higher highs and higher lows, right? But not necessarily true, because if the stock's making higher highs and higher lows, but it's contracting in the range, that's definitely not an uptrend I'm interested in, because that's bearish. The chances are it's going to crash, and especially if it's making higher highs and higher lows, contracting in the range with dropping volume, then that's really bearish, right? So we need to expand on that definition. A real uptrend is higher highs and higher lows, and higher volume to support the move, and closes in the top half of the range consistently. So when you think of all the fancy indicators we use, like the hundreds of indicators we have in most trading programs, most people have things like stochastics, directional movement, on balance volume. Basically, you can summarize all of that with money flow, because stochastics look at where you close in the range. Directional movement looks at whether you're making new highs or new lows. On balance volume looks at accumulation. So all of that can be combined into money flow. And that tells you whether all of those things are happening, and if so, the smart money's in. And so we look at money flow as a very important part of any trade to see basically as something goes up, you know, what's going on with the smart money? Does it support the trade? RXII was a no-brainer, firstly because it met all of the other rules of our strategy. But in the context of money flow, have a look here. Stock goes sideways. Basically, the average price of the stock doesn't change. It's about $2.60. But the entire time, this stock is actually going down, even before it flatlined. Even when it was going down, what was happening? Money flow was loading up. This move, this almost 100% move over a short period of time was being accumulated by the smart money well before it actually happened. Just on the topic of pharmaceuticals, because people often think these things are unpredictable. They're not. Somebody knows what's going on well before the market finds out. INFI is another great example, another one that we actually picked. I've been hot on the pharmaceuticals recently. But look, I mean, again, going down, consolidating, oscillating. At the same time that it's going down, smart money loading up. And there you go. There's your big break. Comes back, test support, and it's up now at $17. So there's a lot of examples. If you want to look at the recent drop in Tesla, it was highly predictable. I had one of my students call me. At the beginning of the week who's just learnt about this stuff, just from one of our recent workshops, and said that he called his sister at the end of last week and said, "Get the hell out of Tesla. It's going to crash." And that was so I was probably on a Thursday or Friday he said that. And if you can see why, because as it was rallying, the money flow was coming straight out very, very sharply before the big drop. So these moves are predictable. All right, so we'll come back to some of those live stocks towards the end if we have time. But once we've started to now understand the DNA of the market, I mean, you really don't need. I mean, I don't need anything more than money flow. I like to have stochastics, and then the chart, volume, and what's price doing. Are candles expanding or contracting? Is volume supporting the move or not? Everything you need to know about the movement of a stock can actually be brought back to a fairly simple and straightforward decision-making process when we understand what the DNA is in the first place, and not get overcomplicated with too much definitional stuff. You know, there's God knows how many candlestick patterns. I've learnt them all years ago. Do I remember all the names? No, I really don't care whether it's a hangman or a bullish engulfing or a shooting star. It doesn't matter, because if you understand what the movement means, you don't need to know all the terminology. You just need to be able to look at the stock and understand what's going on. And when you get that understanding, we can start building a strategy. We can start having a command of our knowledge and start to put it into the format of ideas. And once we start doing that and building scans, now we become efficient. You know, no one, I think, gets into stock trading because they want to make their life more difficult or want to work more. I hope not. I got into trading so I could travel and take the 4-hour work week type of idea. So scans are very, very, very important for me. And once we start scanning, we can make things efficient. So this is the last topic we'll cover. So because this is now getting into the nitty-gritty. When we look at a scan, there are now 4 things that we want to start building or build into a scan. The first thing is the idea. What is the what is the foundation behind why we want to look for the opportunity? So it might be because sectors, it might be a special situation going on in the market, whatever the case might be. So I've created an example here. Let's say that at the moment, we thought that the market was falsely strong, and while it rallied today, we think that some stocks are beginning their downward descent. Now, I actually think the market will continue to go up, but let's just say this was our idea. Well, this idea we now need to start fleshing it out. So what would add credibility or add weakness to looking for these types of shorts? Well, we can start saying that conditions we're looking for may be that it's in a weak sector. Okay, so we might say, all right, we want it to be in utilities. I mean, the three weakest sectors now are energy, basic materials, and utilities. So let's say we wanted to look at something in a weak sector. Okay, then we could go and say, right, what else is going to make it weak? Well, a high P to E ratio, maybe something over 50, right? Because if it's a really high P to E ratio, let's say it's 100, it's selling at 100 times its current earnings, which means that there's a huge speculative value of how wonderful this company is and how much money it'll be making soon. Well, if you do have a high P to E ratio company like that, what you certainly wouldn't expect to find is the people that own the shares and know the company the best wouldn't be selling it. So the institutions wouldn't be selling it. The insiders certainly shouldn't be selling it, not if they're anticipating great growth in the next few weeks, months, years. And to boot, we could add the price to book ratio. So now we have conditions. Now, this still isn't a scan yet. This is just still the conditions, because a stock could meet all of these things and still go 10, 20% higher before it finally breaks. So what we now need on top of the conditions is we need triggers and indicators. So the trigger is what tells us why we need to now buy it or short it now. So an example is we might say, all right, let's say the market went up 2%. Let's actually search for stocks that in fact went down. So stocks that in fact dropped through the support level. And then what we want to see is we want to see that that break of support was impactful, was important. So we look for heavy volume. We look for negative momentum. And of course, the worst thing, if we're buying puts, for example, or if we're shorting the stock, depending, is we want it to continue moving. So we need movement. So we'll look for a high ADX value. So we're basically now with a command of knowledge of what the indicators are, rather than and what they do, we can very easily build an idea out. And if we want to do that, simply we can go into something like FinViz. How many people here have not used FinViz before? How many people have not used FinViz? Okay. There is very good program, very good research tool. Simply what we can do is it allows you to build basic ideas out quickly without doing any kind of real programming or having having a lot of technical knowledge. So we can go into the screener and we can simply say, right, okay, let's say we want utilities. We're going to look for the weak sector. So we've got 119 stocks in that sector. All right. Let's say that now we want to see that the stock went down more than 2%. So we really don't need to actually do a lot more here. We've already narrowed it down very quickly. You can see that we've now got 2 stocks where that was the case. Now we can look at the chart, and now we can actually pinpoint, do we have a technical scenario where there's a good short? So you can see this would have been a perfect short yesterday when it rallied up and hit resistance at around 950. It actually was down now down at 884. So this is a great example of something, had you run the scan yesterday, would have been decent. But we can also look at another, see if we can find something on a different sector. You can see 23% short float, heavily bet against. So there's a lot of, in a bull market, there's a lot of negative sentiment about this stock. And as we know, people who short are generally better educated than those who don't. So they're traders that we want to look at. So there's CLNE. That's probably likely to fall further. Let's go back. Again, we could change the sector. Basic materials is weak as well. Okay. You can see there's 112 stocks that actually went down more than 2% today in that sector. And now, I mean, you could go through all of them if you wanted to and start looking at the charts to find where that weakness is. Of course, the other thing we can do is actually start building in other ideas, which is that maybe the insiders, as I mentioned before, are selling. 26 companies now. And if we want to, we can now add the institutions are selling. Now we've got 11. And now what we can do is we can start looking for technically weak patterns. So NDRO, what do you spot there? You can see that there is a head and shoulders pattern. It's already broken down. That should have stopped somewhere around 1250 had the head and shoulders support kicked in. That's basically what you can see is the difference from the head to the neckline. Should have stopped around there. It didn't. It actually broke through further, rallied up, hit that resistance, and came back down and is now looking pretty poor. And what you can see here, just from eyeballing it, is you can actually see the beginnings of a descending triangle. Equal lows, lower highs, bearish. Right, so this is just a very basic glimpse of how easy it is to find really good trading opportunities. If we look here, GSS, that's a small stock, and we probably actually want to add a price or volume requirement onto this as well. But you can see here, oil and gas equipment again. You can see that descending triangle starting to show itself. So there's that one touch, second touch. It's going to touch the third time here in a moment, probably likely where it'll break. So that's how we then start building the scan and how we start fleshing out the ideas. Okay. Now the final. So now once we've done this, we can now take everything that we've just talked about from the top-down approach, and we can now build the checklist that basically summarizes everything. So again, as a trader, if we're going to be in the business of trading, it's not about gambling. And and what it's also not about is it's not about being right. Your objective of trading is not about being right. It's about following your rules and having conviction in your rules. It doesn't matter how good or bad your strategy is? Well, it does, but the most important thing is that you have one. And if you stick to it consistently, that's what ultimately will make you money. Okay, so we want to do that, we need to have the rules down pat, and we need to be able to decide what we're going to trade through a decision tree. And so here's the decision tree I suggest to you. The first question we want to look at each week is the stock market bullish or bearish? So to do that, we don't look at the TV. We don't look at what your buddy down the road thinks. We're not listening to Facebook and stock twits. What we're doing is we're going to be doing something that is not subjective, but process driven. So we look at the S&P 500 and we simply say, not is the stock market bullish or bearish, but are we at support or resistance? Well, we've undergone a downtrend line here. We've broken out of the channel. So as of 2 days ago, on Tuesday, you ask yourself the question, are we at support or resistance? We were at support. We had broken resistance. We'd broken that downtrend line, that channel. And as we know about channels, that typically happens anyway. Stock will normally resume the original direction out of a channel. If we wanted to go a step further, we could look at the smart money. You could see that we had broken that pattern as well. And we were actually going higher despite lower prices. So are we at support or resistance? We're at support. So we're not subjective, purely rule-based. Therefore, what? Well, the next question we then ask is, are we momentum or oscillating? Well, we were momentum all of this time. We then went into oscillating, and now we've resumed momentum. You can see the moving average is catching it, and that's usually the shift. It goes back and forth between the two. So we're now in momentum. Therefore, we then do the same for the sectors. We go through the sectors and we look at that. We can say which is the strongest sector. If you want to get really fancy, some don't. Sometimes I won't look at the sector, then with the individual stock. But if you want to go a little bit further, you can then do the same process and choose the strongest sector. So right now we are bullish at support, and we are in momentum mode. And therefore, we decide which is the best scan to run to find stocks that satisfy the ideas. So bullish and momentum, therefore this scan. So I would run my fallen angel scan, which looks for things like cup and handles, bump and run formations. Because what your job is to do now is to decide if you're in a bullish momentum market, what are your aces? What is the best, highest probability pattern to look for? So there's 100 patterns out there. You don't want to be trading 100 patterns. You can't be a specialist and be good at 100 patterns. Just like you don't eat at a restaurant that cooks 100 different entrees. Right? You've got to pick a couple to specialize in. So the ones you want to pick are the highest probability, highest profitability patterns. So bullish momentum, that's the one you go for. If we are at resistance in oscillating markets, and we have momentum charging in, you're going to look for breakouts. What's the highest probability breakout strategy? Flag formations. So you search for flags. Don't worry about all the other garbage. Search for the ones that are the highest probability for that market condition. Then we look for smart money. Once we've got the list of stocks that come up in a scan, it's simple. We know what we're looking for. So now we're looking at the price action. We're looking at the couple of indicators to confirm it, and then we'll look at these special ingredients like the insiders and institutional buying. Now, all of this might sound like a lot, but it's not, because the process I've taken you through here is to kind of show you what is the DNA that goes on behind the scenes. A lot of this can be automated by using scans. Because by understanding the DNA and what really makes things work, or what really tells us what's going on, we can then program this into scans, and we can build indicators that combine all this for us, and so that our job is very quick. I don't spend much more than about 40 minutes to an hour each day researching what I'm going to trade for the week or the next day. It should not take you longer than 20 minutes per strategy. So if you're only trading one strategy, you should be able to be in and out, know exactly what you're doing, exactly where you're buying, where your stop loss and exit strategy is within a 20-30 minute window. That's what efficiency is about, right? The computer can do that work for us. We're at that point in technology's age. And the final thing that then you can then look at if you really want to get, as I said, you get high probability, is to then pick which patterns you're going to specialize in. So this is my favorite momentum strategy. Here's my favorite breakout strategy. This is an oscillating strategy that I trade. And of course, wedges are a bit more difficult, but that's consolidation patterns. And for each of these, you will have a different probability of success. It looks like we doubled up there. So, bringing us back down to talk about efficiency. For any of you I talked about the 4-hour work week by Tim Ferriss earlier today. There's some good parts and some bad parts of the book that I don't agree with necessarily. But one part I certainly do agree with is the quote of what is the minimum effective dose. If you know what you're looking for, why would you ever sit in front of the computer for hours waiting for it to happen? Is that really efficient? Tim Ferriss asks, who's richer, the guy who spends 60 hours a week working for 100 grand, or the guy who spends 10 hours a week making 60? I'd agree with him that it is the latter. And in trading, yes, we might be able to make a little bit more by sitting in front of the computer all day, because we'll spot opportunities maybe we didn't expect or we didn't find in our scans. But is it worth spending 600% more time to make maybe 20% more return? I would say no. So I love day trading, and I do day trade, but I don't rely on it. So I do it for fun because I enjoy it. But I don't have to. I can take 2 weeks off. I can take a month off to go to Australia like I did over Christmas. I took a month off this year to travel. And the whole time, I didn't have to worry at all about not making money on stocks, because you can program the entry and exit and do whatever you want. And if you choose, you can day trade for that fun. But you do need a strategy to do that. You have to know what the variables are and how to be consistent in every trade that you approach. Without that, it's impossible. You're going to have constantly changing variables, not be able to replicate why you made money and avoid why you lost, and you won't be able to scan. This is one of the best parts about trading. So I often the trick to this is then staying consistent. So I wanted to show you what consistency allows. This is actually we have a service where we send out throughout the week a 5-minute video, basically picking our favorite trade setups for that week, and kind of where potential entry and exit alerts are, and we send that out to our students. This is actually a summary of. I won't go through the entire thing because it's about 4 pages long, but this is actually a summary of all the alerts that our scan had given that we published in the executive summary. So this isn't cherry-picked. This is all of the stocks that we published in that executive summary and what they did after the alert was given. And basically, there's quite a long list here. Dates back to June 5th. You can see usually about 3 to 5 stocks per summary. Anyway, if you just want to summarize it, it's basically all very much a similar number. It's an average of about 8.37% over a period, I think it was of about 7 to 8 day average. You don't quote me on that, I think it was close to 7 or 8 days. But the beauty about about scanning is that that's what gives you that consistency, because every trade should have the same core components. And when you're trading the same patterns, you should be getting the same result. That's what consistency is about. So well, I'm more than happy to start bringing up some live stocks and things like that and answer some questions. So we'll go to that in a moment. If you're hungry for more, though, this is you can see we do try and pack a lot of information into today. So we have the hour 15, which is usually a little bit longer than the typical workshops we do. So we were I'm glad I was able to kind of get through a lot of this information for you. The next step is now, automating this, taking all this information, having a what's the word I'm looking for? A control of it, being an expert, really understanding what you're doing, not just parroting back, what a bullish candle is, but knowing why it's bullish. Because then you don't need to know all the patterns, you don't need to know all the names, because you know the foundation, the DNA of it. And so the first part of this workshop is the DNA of movement. So just making sure that by the time you leave, you know what the market, how the market moves. And this is applicable for whether you're trading options, Forex, stocks, futures, doesn't matter. It's about how money moves and understanding it. And talking about trend line drawing, by the way, is also a big part of this. You'd be amazed at how many people don't draw the trend lines properly. Because a lot of time people just don't know where the trend line should start and where it ends, or where one pattern starts and another one begins. These are critical, because if you don't draw trend lines in properly, you've got no chance of knowing where to get in or out, or what pattern you're dealing with. We'll also be a strong focus of understanding the smart money, because that is the most important thing, because they control 80% of the volume. So no matter what we believe about the market, what they think about the market is the most important thing. So being able to track it is very crucial, and we'll actually be sharing with you smart money indicators which we developed, which look for key divergence signals in the market when smart money is starting to offload, and it gives you very, very precise warnings of when that's about to happen. And then how to then scan for those opportunities so we can short them. So that's the next part of the trader's toolbox, is the scans. So after going through the DNA and getting a solid understanding of that, then we teach you how to automate it, because we don't want you spending more than 20 minutes a night working with this strategy. We want to make your life simple. Get technology doing all this for you. Now you'll still understand what it's doing, but automating it through the scans is something, therefore, you'll just have to go in, click one button. We give you these free tools that will do this for you. You can also do it in Think or Swim, Metastock, TC2000, all the major programs it works for, and of course FinViz is one of the tools we also will be using. And we'll be talking about the scans that work best in the different market conditions. And finally, options during earnings. This is actually, we've never taught this. Well, actually, no, that's a lie. We have taught it a couple of times, but not in this format. We have options coming around in October. So there's a particular scan that we use that only works to the degree that it works in earnings season. So 4 times a year, this is when this really rocks. And what it's designed for is to find surprise earnings announcements where we're dealing with gap downs of 5–10%, where we're looking for where we can buy out of the money options that usually expire within a day or two, where we're buying it for say 5 cents, and you get that surprise announcement, and you're selling it for $1. So you're talking like turn $1,000 in, if that's the move you get, is 20,000 out, right? So we'll be talking about teaching this to you so that you can be utilizing this if you're an options trader in the earnings season. And we'll be going through and actually running those scans and looking at live opportunities. All you need to do is just go into acornwealthcorp.com/run. It should be a very valuable workshop for you because it will take you through the entire process of going start through finish and being able to start finding opportunities easily and knowing what to do with them and how to spot them. So we'll go to questions. We've got about 5 minutes left. So if you have any questions regarding this or anything we've talked about, or some stocks you want me to bring up on the screen, I'm more than happy to do that. And one thing to mention is we believe this should be of immense value. If you don't find it's a value, we're not in the habit of charging people for things that they don't take advantage of. So if you get to the end of the workshop and you didn't learn anything and you don't make at least $97 from having the extra scans and knowledge, we'll refund it to you. Is Twig's money flow the smart money indicator? That is the bare bones indicator, but we also take that a step further and actually developed our own indicator, which actually is an early warning sell and buy indicator, which is basically a yes/no type thing. So when it goes off, that's when you immediately take notice. And that's actually a combination of quite a few different factors, money flow being one of them. Okay. And you'll see that when you register for the workshop, you actually you get you'll see the links and pardon me, the links and prompts as it takes you through the screens, and you'll be sent an information pack immediately, and we'll also send you a link to some videos that you can start watching straight away, so that between now and October 7th you can actually start learning. And one other thing you can do is we'll send you if you send a quick email to us when you get just reply to the welcome pack that you want to be looking at those trading videos, we can actually send you to the members page where you can actually view all of these videos. Of course, we just published one actually last night, so you can actually start following along with the live trades before the workshop. I'll just bring that link back up. All right, so I'll just pull up the chart above it if we do have any questions. So I'll show you some of the recent ones with the 2 minutes we've got remaining. So again, momentum. So some of the recent stocks that have come up in that scan. Red Robin, again, momentum trade. Stock going sideways, money flow increasing, perfect entry point. Could be an options trade, looking at in the money $55 calls, for example. So Red Robins, you'll see, here's another example, WWWW. Also momentum, very ripe for the current market conditions. Stock going sideways, smart money accumulating, same thing. CLF, Cliffs Natural Resources, another momentum swing, up, tag resistance, pullback. This has also got insider buying and institutional buying.